Hi, good evening, ladies and gentlemen. Thank you for joining on a Wednesday evening for our AAPI Financial Education Webinar, which is a sponsored program here today. This is about investment and tax planning strategies during these turbulent times of market decline. And your host is yours truly, Ravi Kolli, President of AAPI. As you know, AAPI is a non-profit organization, and this is an education webinar, and all attendees should consult with their own private financial advisor for their own personal recommendations and financial planning needs. So that is the disclaimer I want you to be aware of. And also, we will not be talking about any individual stocks and things like that. So with that said, let's review the scenario that we are dealing with at this point in time. We're seeing a lot of volatility recently in the market, with the S&P being down more than 20% from its peak, and some are calling it a bear market. We see physicians are rather concerned about their portfolio and further market downturn, especially if they're at the stage of life they're looking forward to a very golden retirement years. So what should we do in this kind of environment to navigate these ups and downs? What should be our investment strategy in this market decline time? So to discuss this, we have Mr. Syed Nishat, who's a good friend and a very young but a very dynamic speaker who gives a very balanced view of markets and investment strategies. Syed is a fiduciary financial advisor and a partner at the Wall Street Alliance Group. Syed has written articles and interviews about asset protection, common financial mistakes by physicians that are published in MedPage Today, Medscape, and other online publications and print publications. He is regularly quoted in interviews in media outlets such as Forbes, Kevin MD, US News, Investment News, and Yahoo Finance. We would like to make it an interactive session rather than just a presentation with no real participation. I will ask 10 questions that Syed will answer, and you can also ask questions in the chat box. And again, ask your questions in the chat box, and we'll try to answer them as many as we can. If not, we'll send some kind of response through email or some other way. Thank you again. Syed, now it's your screen.
Thank you, Dr. Kolli, for inviting me to this AAPI webinar, and thank you for the wonderful job the AAPI is doing for the community. From the very get-go, we are following it from COVID all the way down through. You guys doing a great job in the front line. Now, before we speak about the market, if it's okay, I just want to give you some preview about the tax planning because the October tax deadlines are coming. Just as a warm-up, and then because what happened, tax planning extremely important for physician that tied up with investment planning as well. So October 15 deadline is just in a couple of days. Those people who have taken extension. Now, 2022 is almost over, but there are a few things I think physician can actually use the tax changes that can help them prepare well for the tax planning for 2022. So some of the new tax changes, when Trump became president, the property and state tax, the maximum deduction called SALT was only $10,000. So let's say if you have a state tax you pay from the income and the property tax, the max you can write off is 10. States like New York, New Jersey, Ohio, even Pennsylvania, they are in the Senate. They are saying that if you have your own corporation and pay the same state tax from the corporation, you get the full deduction. Extremely powerful. So for example, if your state tax is less than $50,000, if you don't do anything, you only can write off $10,000. But if you have your S corporation, pay the same $50,000 from the S corporation, you can get to write a full $50,000 from federal level. Again, very powerful. Number two, tax planning tips to understand. This is the last year to get 100% deduction for meal. Usually when you spend money on food expenses, qualified expenses, the maximum deduction is 50% of the money you spend on, but this year is 100%. Number three, if you ever need a bigger car, this is a good year to do it, is because if the car weighs more than 6,000 pounds, you can get to write off the full purchase price of the car. So for example, if you bought like a car worth of $80,000, if you use it for the business, as long as you use it for the business, 80,000 full, you can get to write off on the federal tax bracket. Final two things to discuss about cost segregation. A lot of our community, it is quite common for physicians to invest into real estate. At least for the last few years, we've been seeing people investing into real estate. Cost segregation is very important because what happened in Dr. Kolli in America, when you buy a real estate, there's a depreciation schedule. What does it mean? Like it's a 39-year depreciation. You can get to write off the depreciation from your income. So the 39 years is up to you though. If you want, you can actually get the write-off quicker if you want to. That study is called cost segregation study. You have to pay a little bit, but the benefit is all the depreciation you will get in advance, you can write off of the income. And I was give you an example. I was talking to a client of mine who was a surgeon in Houston, bought a surgery center for $1 million. We did a cost segregation. We get the advanced depreciation, 300,000. We got a advanced depreciation. So all the rental income the client will collect up to 300,000, no taxes. And lastly, defined benefit plan, physician do it, self-employed a lot. But the good thing is you don't have to rush into it to do it in December for 2022. There's something called Secure Act passed that become law in 2021. So according to Secure Act, you can actually delay the defined benefit plan and open it until the tax filing deadline for 2022. So that means until next year, March 15, with extension until September 15, you can open a defined benefit. And I think it's very powerful defined benefit. Just to reiterate how important is it, if you're a self-employment physician, and if you're 52 years old, you can contribute in a defined benefit plan $193,000. And this money is completely tax deductible. So if you're in a 40% tax bracket, we are looking at a tax savings of almost $77,000 a year. And in 10 years, that translates into almost $772,000. So again, these are a few of the small tax planning tips. Before December happens, speak to your CPA if any of them make sense for you.
All right. All right. So let's start with some quite interesting questions that are relevant to the times that we live in. Again, we said today, November 15th is coming up soon, and one of them is me who took extension. And actually, it is October 17th is the deadline today, right? This Monday rather than
Correct.
Sunday.
It is. It
We have
is.
a couple of more days to relax.
Correct.
So before getting into the market volatility, can you please, you did talk about some latest tax changes that we should be aware to plan better for 2022. Can you elaborate more on the tax changes that are going to impact our planning for next year?
Yeah. So as I mentioned, that the tax planning I discussed about, all of them are for 2022. We're talking about, which is actually this year because the year is almost over. So all the strategy we'll talk about are actually for 2022. There are a couple of questions I see it in the chat box that someone asked that is the auto tax write-off only for self-employment physician? Yes, you need to actually have your own corporation to get this write-off. So as long as you use it for the corporation, you can get the write-off as well.
Right. Is there any requirement with like you commute to one point to the next point or something like that? How does that work?
Yeah, you have to use the business, the car for the business purpose. So for example, if the car is for $80,000, 70% if you're using it, so the 70% of the car value you can get to write off for the full business price.
Okay. So another question that is also in the question chat box is, please talk about investing in bonds, short-term bonds, how to find them. The Dr. Nilakanta doesn't have a wealth manager. I think Syed can be one of those. Can you go ahead and answer that question about short-term bonds?
Yeah, so short-term bonds is okay, but by all means, we are kind of avoiding the bond market because the interest is going higher. Because what happened, the CD, it is giving right now almost, for example, Fidelity, I was looking into it, 9-month CD is almost 4%. Treasury, 6 months Treasury is almost close to 3%. And the bond issue is, even if you buy short-term, if the interest rate spikes up, the actual price drop though. So that's the problem with the bonds. So yes, short-term bonds most likely is okay, but if you're really interested in, my suggestion is for non-qualified account, like non-IRA account, go for municipal short-term bonds. Like, for example, you are in Pennsylvania. I'm giving just an example. You can buy Pennsylvania municipal bond fund. Then there's no state tax, no federal tax. Now, IRA account or defined benefit plan, qualified plan, we are recommending go for over there CDs or treasuries. I understand treasury, there's no state taxes, but again, they're higher yield. It is a better equipped to do it versus just buying bonds.
Okay, sounds great. How about that instrument called TIPS? I just don't know much about it. I want to learn a little bit about it. Can you talk about it?
Yeah, treasury protection, tips,
Inflation protection.
yeah, tips, treasury inflation sector, those are coming into play as well. But the issue is the tips are already in play because the inflation is already spiked. You should have bought it like before that. So treasury actual bonds are better. Don't have to go for tips right now because inflation most likely will go high short term, I understand, but most likely it will be under control. And we'll discuss more about it, the market outlook in a bit.
Okay, so there's one more question. Maybe you can talk about rights and for high yields later, but let's get to the market situation right now. What is the main reason for this market volatility, and what is your market outlook, Syed?
Yeah. So let me just give you the main point, the market volatility, why the market is down. And there's a philosophy going on right now. But one thing to see, if you just take a look at the market chart since 1930, all the way in this year, S&P since 1920 till now went to bear market. Bear market means when the market fall more than 20%, almost 28 times. 28 times market fell since 1928. Each time, if you look at the graph over here, the green point, one thing is common, the market recovered. Sometimes it took some time, sometimes it took a short period of time. Now, the number one question becomes, what is the main reason why the market down this time? All right. Now, there are two rule of thumb, and people need to pay attention. This is what Wall Street is thinking. This chart, if you take a look, I mean, I don't know if you've been in US when Jimmy Carter was a president. So I came to 2000, but my father used to say when Jimmy Carter was president, at that time, the mortgage rate was 18%. When Carter was, so this is like in the 1980s we're talking about. So the stock market feared that this may happen, and that's why you can see the market is going down. Okay. This is number one philosophy. And people and some guru are saying it will be a deflation. Deflation means inflation is there, number one, and it will take some time to fix the issue. So now this time, this lag, the inflation is dragging on. There's no productivity. That's called deflation. All right. So that's what the market is talking about. That's what everyone is talking about. This is what White House posted. If you see it, a few months ago, White House saying that this is not going to happen when Carter become president. They are saying it will be like 1944. This is when Truman became president. World War, II, when a lot of soldiers came back, they need to buy house and stuff. So there was a shortage of supplies, to make materials. So there's a supply chain issue going on. So that's why for 1944, if you see 1944, 1946, there was a huge spike, almost 20% inflation happened, but the Fed was able to control it, and then the market, kind of stable. So they are saying, the White House is saying is going to be short term, it's a supply chain, because if you take a look in China, as a physician, you probably know today the COVID cases went up. They again had a lockdown. And they are saying that the supply chain, like Apple, they're having issues. I have two kids. Few months ago, I would say I didn't have baby food. So this issue was going on supply chain. When they fix it, they're saying the market should spike up. Now, who do we listen? That's the question. So, in my opinion, the way we see it, like is Thomas Jefferson, and then some economists said very nicely, like inflation is like drinking alcohol, like printing money. When you print money, it's like drink alcohol. When you drink alcohol, you get buzz. So that's printing money. So that we saw so far the good news. So the good things you hear first. The bad thing comes later. What was the bad thing for this? The bad thing, we saw that everything price is going out of roof. In New York still, we see a huge amount of bidding war for a house. So this is the effect of the cheap money. And this cheap money didn't happen, Dr. Kohli, for 1 year, 2 years. It's happening since 2008, though. Okay, so that's the effect. Now, how do you fix alcoholism? The way you fix alcoholism is you take a pause, and that relate to stop printing money. Now, when you take a pause, the body start to react, and that's basically called, in this situation, we're seeing the bad news first. So the stock market is going down, so the bad news comes first. The good news will come later. So, one thing to understand in 1944, or if you just go for Carter, one thing different from now, the money printing, we were printing money like crazy. Now at that time, money printing wasn't a regular norm. So what happened, the dollar becomes stronger right now at this stage, so everything is becoming stronger. So I don't think, as a financial advisor, our team, we don't think that people are used to the market goes down, you buy it, and in 1 month market goes up. It's not going to happen. It will take about 3 years, because for 8 years we had zero interest rate, right? Even if you take a look, the SBAC loan, like the PPP loan, the government launched, and also there was a program. It's a SBA loan. A lot of people, what they did, that they took the SBA loan, is supposed to be used for business. The rate was only 3%, and they invested into the stock market. It happened. So because of this issue, that still there's a huge influx, a huge supply of money there. The money needs to carved out. Now the issue Fed is facing, Dr. Cole, is that they're raising rate. It is not getting controlled. Like for example, Kentucky, recently I visited for a presentation. Interest rate is 7%, right? Almost right now, mortgage. But commercial is not 7, is 7 plus prime, which is about 9. Still people are buying it. So the effect, we haven't seen it. So there's a small possibility if Fed may go up to 12% interest rate. So if that happens, the economy. So the only way to fix the inflation is recession. Understand? There's no other way to fix it. So recession must happen. But so that's why Jamie Dimon, everyone is saying that next year, 2023, we will see recession. But the thing is, remember, at that time the market will go up. So right now, market is going down into good news. Unemployment is good, market will go down. Inflation is bad. Job data is good, market will go down. But at one point, job data is bad, opposite will happen. So as long as you have a 3 years time horizon, I think this whole cycle the Fed created, it should be absorbed. So this year is past. I don't think this year market will be higher. Next year market will be flat, and an average stock market return around 9% per year. But for the last 10 years, market is up around 14% per year. This is crazy. So it will average down. So in 3 to 4 years time horizon, I think the market will be higher. Hopefully, people have that much time horizon to retire. You should be fine.
All right. That was a very elaborate, a little bit complicated for some of us, but there are a lot of savvy investors in Not Physicians Group, but they also have a lot of pitfall that they need to navigate as well. So do you want to take some questions that are posted, or shall we go to, let's see what we have here. How about REIT for high yields? What do you want to say about that?
Yeah, so the REIT, we are avoiding it because REIT, real estate investment trust. So it is true that, for example, there is a REIT called NLY. I'm just giving you just an example. The REIT, the rate is almost about close to 14%, 20% it went up. But the REIT invests into real estate. We expect real estate to take a dive. The only way to fix this whole inflation is with the real estate. So my concern is the price of the REIT, what will happen? So the price does go down if the interest rate keep going higher, although the rate going higher. So we are avoiding REITs. But if you really, as I mentioned, are interested into yield, go for treasury, go for CDs. They are much better.
Okay. Here's an interesting question. I'll give my answer before you go into that. So one of the question was, some people have 529s, but the kids are all done with their education. What do they want to do with that money? I would say, why don't you go to law school or something on top of your med school? But go ahead, Syed. Go ahead and.
Yeah. So to answer you, to elaborate more, yeah, you can go to law school, pay the money for your own education. You can use grandchildren is a good way to do it. Relative, if you want to help someone, or worst come to worst, what happened that you can just take out the whole money from the 529. You pay no taxes, penalty on the principal, only in the gain though. All right, so it still is a win-win situation, only in the profit portion. So this is another option.
Right. So the 529 was invested after the taxes, right? So they don't have to pay the taxes on the original, but on the returns they have to pay.
Correct.
Okay, very good. So let me see if there's any other question that our members are asking. Right. I think we already answered some of them. Let's see next. Can I use 529 funds for my own CME? And that's an interesting question. I never came across that. Go ahead and.
Yeah, so the you can use it for pretty much 529 for any qualified reason for yourself if you need it, as long as the CME required it for educational purpose is fine. What I would do if I were you, I will just call the custodian. Like for example, if you're Fidelity 529, you just call Fidelity 529, explain this is for CME purpose. They just double check and they release the money. But you just put the notes. But I do have clients who have used for educational purpose for CME, it did cover.
Interesting. I thought the 529 disbursement go directly to the institution. Isn't that not correct assumption?
Yeah, so I'm assuming that this person who asked the question will be transferring the 529 under your name. And then from there, you can 529 understand one thing, you can just always write a check and reimburse yourself. It doesn't have to be going direct to the institution. So if an IRS audit happens, you have the bill you paid. It doesn't have to go directly to the institution at all.
Oh, okay, very good.
Yep.
What is the impact of energy on inflation rather than just the supply chain? I think that's a very relevant question during these times of energy.
Right. So the main reason, one thing to understand on top of this supply chain issue is we're decoupled with the issue with Russia. So that is having a huge impact on the gas price. OPEC is also, cutting down the, output as well. So yes, if the gas price goes up, the first thing, if inflation happens, gas price does go up. So yes, it does have effect on the inflation, but I think the bigger issue is just not the gas price. The bigger issue here is the liquidity. Still, people have a lot. Still, there's a job market is very strong. The inflation, we see the gas price, it is an effect of the inflation. So it's not because of the gas price the inflation is happening. So then people could have been fixing it. Is because the other issue going on, because if you must have heard the great resignation, a lot of people don't want to come to work, so there's another issue going on. It's hard to find employment is going on as well, is because people do have fluent money in the market. As soon as the demand for all this product goes down, I think the market should balance out. That's the main issue the Fed is trying to fix. So Fed has a major role to play because they haven't increased the rate soon enough.
Okay, great. So Dr. Gundappa Nilakanta asked, I heard something about backdoor IRA. I get a W-2, his income is W-2. How can you do a backdoor IRA?
Yeah, I think it's a great time to do a backdoor Roth IRA. So if you're all W-2 employees, or if your income is high, usually for combined income, then most physicians don't qualify for Roth IRA. But what you can do something called a backdoor Roth IRA. So the way the backdoor Roth IRA works, you open a post-tax IRA account. So let's say, for example, I'm picking you, Dr. Kolli, you are a W-2, for example, as an employee for a hospital, and as long as you don't have any other IRA account, you can personally open a post-tax IRA account and contribute, for example, over the age of 57,000 for you, 7,000 for your wife, $14,000. But at the same time, you open up a Roth IRA, same time, and you transfer the money to convert the money to the traditional IRA to Roth IRA. Since you do it instantaneously from traditional IRA to Roth IRA, there's no taxes due and there's no penalty whatsoever. All right, but the beauty is once you convert it to this Roth IRA, the money grows tax-free. The withdrawal is also tax-free after the age of 59 and a half, or there are some various rules as well. For example, after 5 years, first time buying house, educational expenses you can pay for as well. But it's very powerful. Most physicians don't do it. Definitely, it's a good strategy. Backdoor Roth IRA is very powerful.
Yeah, and there's some more questions regarding Roth IRA. You might have already covered it, but let me ask those questions. Is it good time to convert to Roth IRA? And backdoor IRA, I have a 403 and have maximized my pre-tax contribution. So what is the option there?
Yeah, I think it's a great time. Yeah, I think that's give me a good segue to a Roth conversion. It's a great time to do so, because unless like you're a magician, you will be down in this market, including myself. So for example, if you most investors I know, they are down at least 12 to 15%, depending on where you have done the investments. if you have invested, remember, in a traditional IRA, in a pre-tax money, is tax deferred, it's not tax deductible. You do have to pay taxes later on when you take the money out. But since the market is down, if you have cash sitting in the bank, one investment strategy could be, you pay the taxes because when the market goes back up, the Roth IRA will grow tax-free. Let me just give you an example, elaboration a little bit. So let's say, for example, you have a $1 million retirement account, market went down, the value come down to only $1 million. Right now, I'm just saying it. If this $1 million, I'm hovering my mouse, 9% growth happened, that 10 years, the value becomes 2.
We lost the whole audio here. Can everybody hear our Syed? Oh. Oh. Let me call him. I'm not sure what's happening here, but we have a little bit of an audio pause here. And are you, anybody else having the same problem? I can't hear anything.
We can
Oh,
hear.
you can.
But he is not.
Okay.
You can hear us?
Yeah, now we can hear.
Okay, all right. So what I was saying that that once you convert the money into a Roth IRA, the money grows completely tax-free, and the withdrawal is also tax-free as well. And you save almost close to $300,000. Pay taxes right now versus the $710,000. So we're talking about $410,000 tax savings, and then we're talking about the difference is almost close to 410,000. So absolutely, if you have funds right now, do the Roth conversion.
Yeah. So we have questions pouring in.
Yeah.
So let's go to the question. Some of them were about not able to listen. Okay, is strong dollar responsible for the gas prices going up? Dr. Piyush asked that question. Any thoughts on that, Syed? Probably that has something to do with it, but.
Yes, the strong dollar has something to do with the obviously the gas prices, because obviously the import price does go up. It that does indirectly translate into the consumer. So yes, definitely it does have an effect on the market. So yes, so strong dollar is bad overall for US, because what happened, like if the dollar becomes stronger, I'm just saying it that the company production cost goes higher. So companies like Procter and Gamble or company who are manufactured here, they actually have to produce the same products into a higher expensive price. So that does have effect in inflation, correct? All related.
Right. Yeah, I mean, strong dollar is not good for export
Yes.
market, as well as some imports like gas, which is
Correct.
a kind of entire globe has. Other economies are suffering with a high dollar, so
Correct.
there's a lot of corrections happening. That's good. So for next 2 years, can I make money in oil and gas ETF or stocks like XOP and XLE?
Yeah, so it's already high. So we are late in the game. So what I'm saying that's why diversification is important. One thing, we don't want to do something called fool's rush in. Like, you don't want to like. So a lot of times we see that, like, for example, Bitcoin, everyone was talking about Bitcoin just about 6 months ago. Bitcoin, 50,000 right now, 20,000. So full rush in, don't do it. It's already high. It's not time to buy, it's time to sell it. Buy those which are down, which is like technology sector, blue chip sector, which are down right now.
Okay. So probably you might have answered, I may not have paid attention. Is it true that 5-year rule applies after Roth conversion?
Yes, remember we spoke about the Roth conversion. Once you do it, maybe the mic become muted at the time. After 5 years, the Roth IRA, basically you can use the money for other purpose as well. For example, first time buying a house or emergency purpose education, 5 years will kick in.
And also, is the limit for IRA conversion is 7,000 per year per person? That's one question.
Yes, over the age of 50, you can contribute 7,000 per person, husband, 7,000 per person, wife, so $14,000.
Okay. And who should be named as, I know you want to go into asset plan, like a tax planning and asset planning things into right now, or do you want to talk about?
Yeah, so one thing I can just pivot my slide very quickly.
Yeah.
For estate planning, since we're talking about that, so one thing to understand for estate tax changes for physicians who are high net worth. So as of right now, any net worth more than 22 million, if husband and wife both dies, there is no estate taxes due. All right. Everyone is happy about it. But one thing to understand, no one is talking about it in 3 years. In 2025, it's expiring. Most likely everyone will let it expire, and it's coming down. Is altogether $11 million, so 5 million per person ballpark is coming down to. So physicians who are high net worth should do something right now. What are the solutions? For example, just to give an example, why is it important? Single person, 11 million right now pass away, no estate taxes due. If the law changes, I'm hovering my mouse, almost 2 million state taxes due. So again, something can be done. What other things can be done? You can gift right now if you want to almost 22 million from your state. There's no, state taxes due if you want to. You can give it to a gift. Some people ask the question, what is the best way I can give it to my children without losing control? Speak to your estate planning attorney about SLAT, SLAT, Spousal Lifetime Access Trust. In a SLAT, you can gift almost 22 million, but through your spouse, as long as you have a good understanding, she can give the money back to you through SLAT, and all the assets are in your control. And right now, also, one thing you can do, you can gift every year almost $15,000 to $17,000. The limit keep changing to your children without paying any gift taxes. You can buy some life insurance. You can do some charitable planning. Again, a lot of things can be done, but one thing to just remember: the threshold is going down in 2 years.
So if you're going to die, it's a good time to die, I guess.
Yes, yeah.
And maybe they can give to AAPI as well, right?
It's a good time to do some charitable trust planning for AAPI. Also, in terms of if net worth is high enough, absolutely. So to answer someone, I think asked a question about the estate taxes, I can respond. I think the question was, who should be the trustee, I believe, right?
Mm-hmm.
Yeah. So it's saying who should be a named beneficiary traditional to Roth IRA. If the living trust is a beneficiary, then children only 5 years to withdraw funds. Is that correct? Someone just asked a question. If you take a look, it's a very powerful question. Let me repeat: who should be named as a beneficiary for traditional or Roth IRA? If living trust is beneficiary, then children only have 5 years to withdraw funds. Is that correct? This is a very good, important question. So the primary beneficiary should be the spouse. Anything happens to you, your spouse should be the primary beneficiary. Secondary beneficiary should be the trust. All right. Now, the second point this person mentioned, you only have 5 years to withdraw the fund. Is it correct? It's not 5 years, you have 10 years to withdraw the fund. So this is one of the questions I think you were supposed to ask the 10 question, but someone is asking us, I'll just answer anyway, get it out of the way. This is better the audience are asking. So Secure Act, for everyone to understand, that come into play. Secure Act become law just a couple of years ago. Before Secure Act, if you die, your children who are non-minor, they have their whole life to slowly take the money out. It's called required minimum distribution. So for example, if me and my wife pass away, my child who is 21 years old, that child, $5 million slowly can take the money out throughout the whole life. And it's a little bit taxes due. Secure Act, what they did, they just changed the law. They are saying that now within 10 years, you have to exhaust the money. What does it mean? So this $5 million, either you can take out $500,000 every year, or at the end of 10 years, $5 million. Issue becomes that you have to pay a huge amount of taxes. So again, this is part of the conversation. You need to have it. This person asked a very intelligent question. Speak to your estate planning attorney. This needs to be incorporated into the financial planning as well.
Okay. So somebody asked questions about rupee going to like a low compared to dollar. What are your thoughts about the future of the rupees?
Yeah, so eventually I think they will fix the issue. So it's not just rupee, is my clients who are overseas, every currencies are going down at this point. So even for example, British pounds, take a look, become very down. It's like equal right now, it used to be. So is this not a time to switch back though? Again, as I mentioned, you just have to hold up a little bit, let this inflation cool off, and it will level out in a couple of years.
Okay, there are a couple of questions. Why not revocable trust versus irrevocable trust? And then also, can you comment on granted trust?
Yeah. So why not revocable trust versus irrevocable trust? So usually we recommend doing a revocable trust because you want to completely control all the trust while you're alive. If it's irrevocable trust, what happened? You cannot control it. It needs to be gifted. One way or another, you lose control over it. So unless your net worth is more than 10 million, we don't recommend any given time to do that much of a, unless like you're very close to retirement, you don't need money whatsoever. I highly doubt it. Everyone needs money. So then don't do irrevocable trust, just do a revocable trust, because what happened when you die, that trust becomes irrevocable by law of the state. All right. Irrevocable trust, you only do it if you want to gift it, an asset protection. But it becomes very complicated estate planning. There are other tools available rather going to irrevocable trust. And grantor trust, basically, it is, so grantor means like I'm the person who's setting up the trust. I'm the grantor of the trust. So that's basically called a grantor trust. It could be for asset protection, depending how you want to use it. But yes, it depends on your situation. So most revocable trust for the grantor, you create it, and you can have separate trustee or same trustee. So revocable trust, that's not applicable. But for the irrevocable trust, this grantor plays a major role to play.
Okay. Let's go to some more important things that people are on top of their mind. You spoke about gifting to the children, what kind of trust is the best way to set up to accomplish those. Now, what are the mistakes to avoid in this market, especially who are close to retirement?
Yeah. Some mistakes to avoid in this market. Number one, we see the biggest mistake to avoid is margin. Like people borrow money to invest. By all means, avoid it, especially if you're close to retirement. And because the margin rate is not 2%, it's more than 4 right now. So understand, you have to make 4% just to break even, and you can get margin call as well. All right. So by all means, avoid margin. Number two, not properly diversified. So one thing people are doing, that if they have garbage stock, they're just holding it. It's time to so think logically, Dr. Kohli, that company like NVIDIA, I'm just giving an example. They are down 40%, I understand, but the whole NASDAQ is down 30% too. So NVIDIA may shoot up tomorrow, but the chances of the whole index going up is higher. So it's very important to actively rebalance it, in this market. So make sure the garbage stocks are out, rebalance it, because as I mentioned, it will take about 3 years for the market to recover. Like it happened before in 2000, 2001, 2002. It takes about 3 years for the market to recover. So it may happen. It's very, very important to have properly balanced, have the right stock that goes higher. Don't keep garbage stock in your portfolio, number one. Another good important things to mistakes to avoid: market timing. Like I was talking to Dr. Kohli, a client of mine last week. He panicked. He called, sell everything. Just sit in cash. I will buy. Market will go down 40% in December. I'll buy it. Really? How do you know? So this kind of stuff like, oh, I just heard it. Billy Graham was saying in news, it may happen. So this kind of stuff, by all means, market timing is very dangerous, especially because by the time you realize market is down, is already down most likely 20%. Let me give you a statistic that since for the last, I'm thinking 2001 to 2020, the average stock market return is around 8% per year. But as an investor, if you just missed the best 10 trading days, your return instead of 8% becomes less than 1% per year. So that's why market timing is very dangerous. But one thing you can do, you can actively rebalance it. Like don't sell everything and sit in cash. What you can do, that if you're have some stocks that are not moving, sell it, and buy the stock has chances of going higher. This is not time to be super aggressive because everyone is down. You are down, I am down. When everyone is down, don't have to be that creative, honestly speaking. Just buy the right stock, it will go high. So these are the top 3 mistakes I would say for people to avoid it.
Okay, you're right. Like they say, it's not timing of the market, but what time period you're in the market is
Correct.
matters, right? And
Correct.
also, when you're trying to exit, you have to be right 2 times, when you're going out and you're coming back.
Yes.
So that's a very tricky situation.
Correct.
And also in that aspect, there was a question about what sectors to avoid. Do you have any particular thoughts on that?
Yeah. So again, someone asked the bonds. I know the short-term bonds are okay. I'm all right with it. But long-term bonds, by all means, you should have already sold it, because what happened, even the mid-term bonds, like bonds are like, 5 to 10 years, they're also down, I see 10%. So bonds, avoid it by all means. Pro leverage product, I see a lot of physicians buy it's called QQQ 3 times. It's like some ETF. So what happened that QQQ goes up, this ETF goes up 3 times. It's not worth it. So don't go for pro leverage product. Commercial real estate. So that's why I have concern about REIT, because what happened, I was talking to a client of mine in Dallas. We're buying a retail store, and the construction cost, Dr. Kolli, is up 100% last 1 year. So you give this money to all these REITs and everything. They take your money, invest into real estate, right? So think logically, what they're gonna do? They're gonna take your money, buy the same real estate expensive though. So I do have concern about the cap rate, how they're gonna make it. And if the REITs file for bankruptcy, your money is gone though, okay? And there's a lockup as well. So commercial real estate, try it by all means, avoid it. Residential, if you just wait until December, let the mortgage rate go up, then it's okay to buy it. And again, garbage stock, like for example, if you a lot of people are tempted to buy companies like, I'm just giving it again name, like DocuSign, Zoom, like we're using the Zoom and all of this. Those stocks are like high flying stock. Fine, but don't put everything into this. Make sure you have the blue chip company. So these are the sectors to avoid in this market.
I guess it's time to be conservative rather than speculative.
It's time to buy blue chip, but that has room to go higher when the market recovers. It's not true that all this speculative stock will go back up when the market recovers.
So it's not the time for those meme stocks. Those their prime time is over.
Correct.
Okay. I think you answered the question about REITs. Should I sell for loss and all those things? Actually, one basic question: what is Secure Act 2? Dr. Raj Modi asked. I think you might have mentioned, but can you explain again?
Yeah, Secure Act, the law first one become law in 2021. Secure Act 2.0, they are they just passed it, House, but Senate, they're still reviewing it. 2.0. So that's why I'm not talking about it, is because, but Secure 2.0 could be a game changer. People are talking about, for example, the RMD is required minimum distribution age is going higher. It is right now 72, but right now, just to give you an idea, is coming to 73, 74, 75. Every year is going higher. You can have a catch-up contribution. That spoke about it. Catch-up contribution is if you're over the 50, if you have a 401k and 403b, the catch-up contribution almost $10,000. So there are good things that are coming into play. Security 2.0, but it's not a law yet. They're discussing.
Okay, so it's not a law yet.
Yeah.
So usually by the time it comes out, it completely morphs into something else.
Correct.
Yes. Okay. And what is the time lag for CD to reflect the Fed rates? Currently, CDs are not reflecting the. I don't know. Let me see the not reflecting. What is the time lag for CD to reflect the Fed rates, because it's not reflecting yet?
Yeah, it's not. So this is the anomaly going on. So if you take a look at 6-month CD and 9-month CD in 1 year, kind of same. What are you talking about? It's like the same rate. So it's like an inverted yield curve. So it's taking about a month to have that effect. So for example, I want to buy a CD. So I thought Fed raised the rate, the CD will instantaneously go high. No. It takes some time. So it takes about a 1 month lag, 1 to 1 month and a half lag to see it. That's the lag we're saying. But we do see the treasuries reflecting fairly quickly compared to the CDs. So just to elaborate a little bit, what sector to focus on, if you see my screen, you guys, physicians have until October 30th to buy something called Treasury iShares. or I still have time, about close to 20 days. So in Treasury iShares, the max you can do is $10,000. Is right now, because of inflation, is 9.62% rate. It's a 5 years lockup, but every year you have the option to get out of it. All right. So, but as of right now, the rate is almost close to 10%. So get into Treasury iShare for you, for your family, if you can. I think is very safe. Long term will be higher. Financial sector
actually, there's a question on what are your thoughts on I-bond? Is it the same thing?
Same thing, I-bonds, correct.
Okay,
we should definitely do it, because it's because what happened every year, you can contribute in it, but it's going to be a new I-bond. But right now, this I-bond, which is expiring in a couple of weeks, you can buy, still have the option. You cannot buy it through financial advisor. You have to buy directly with Treasury Direct, but very friendly. Number two, financial sector should do well. So rather buying REIT, you can take a look into sector ETFs like XLF. Those have room to go higher because bank makes more money when interest rate goes higher. Consumer staples, they're recession-proof business like McDonald's, Coca-Cola, these kind of company ETF, you can buy it. They have the way to actually give this money back to the consumer to charge it back. So again, consumer staple sector go higher. Commodities. So usually, so this is I'm talking about to replace the bonds. To buy these sectors a little bit, it will help. So commodities, for example, gold, silver, copper, if the inflation is there, they tend to do well. And utility sector, Dr. Kolli, like Con Edison, XLU, this kind of ETFs tends to go higher when recession hit, because New York is fall. I'm sure I'm going to use heater when winter hits. So again, these sectors tend to do well when recession happens. So these are the sectors to focus on during inflation.
Okay. Can you comment on cost efficient strategy versus buy and hold?
Yeah. So I think the question is buy and hold or cost efficient strategy. So so in this market, some of the strategies to talk about is like rather like completely buy and hold. What about you do something called tax loss harvesting or dollar cost averaging? These are kind of tied up the cost efficient, that they're talking about. So for example, I'm just giving you in this market, one of the strategy could be that if you have a stock which are down in a non-qualified account, book a loss. You might be thinking that, what do you mean by just book a loss? Those stock will go back up, but you can just buy the ETF that will go higher as well. For example, if you have a company like Netflix, it is down, you can sell it into the non-qualified account, and you can just buy something similar, but this loss you can carry forward. So this is called tax loss harvesting, and this loss you can actually write off from the real estate gain as well. This is a good time to gift money to your state. Like for example, if your net worth is 20 million, because the market is down, it may have gone down, but now you can gift it. All the money will grow estate tax free. Number three, it's a good time to buy ladder CD or treasury, and it's a good time to do something called dollar cost averaging. The person asked the question that the market goes down. What you do, you slowly sell the bonds and slowly buy into equity. Market goes up, you slowly sell it, and then basically reduce the positions of the bond. So again, it's a cost efficient structure. This is better than buy and hold completely, don't do anything, or sell everything and then buy it.
Okay. So some questions about mortgage rate are expected to increase drastically till December 2022. Yet residential real estate prices are not coming down proportionately. What to do if you're looking to buy or sell residential real estate?
Yes, so absolutely. So that's the main reason, the main challenge. The Fed that's why the Fed used the word, we're going to keep raising it till the job is done, because the rate is keep going high. People buying in cash though, all right? So so that thing is not over. So if you're looking for residential to buy it, you should wait, because the government wants the market to go down, right? So it will stabilize it. So patience is the key in this market. First, stock market goes down because it's digital. We see it, right? Real estate, we don't see it. There's a lag of it, 6 months, 1 year. So then wait, you will see the result of this whole inflation or interest rate going higher in 6 months.
Okay. A very interesting question here. Probably other people know. I have no idea. I-bond limit is $10,000 per social security number, but can you buy additionals in a gift box? What do you think about that?
I think as a form of a gift, I'm talking about this person is talking about. Yes. So yes, you can buy through, it's per social security, but if someone have an irrevocable trust, so it's separate tax ID, you can try to buy that. Is per tax ID per social security. Now, one thing you don't want to do, that some people are saying, hey, by the way, I have 5 LLCs. Why can't I just buy 5 LLCs? Well, listen, so you may be getting away with it, but one thing to understand is LLC are pass-through income, so we're not sure how it's going to affect it. So the limit is 10,000 per person. You can gift it if you want to, but for that particular, you already bought it. If you try to buy in the system, it should reject it, right? So it's a 10,000, but if you have irrevocable trust, if you have a revocable trust, you can try to buy those as well under that.
I think Dr. Arun asks similar question. Is it true that you can invest up to $60,000 in I-bond by creating a trust? I guess not, right?
Well, basically, what he is creating 60,000 for the family members by doing it. Yes, for each family members, you can buy 10,000 each if you have 6 family members. Correct.
Okay. What happens to I-bond rates after 1 year?
Yeah, so I-bonds rate is not guaranteed. So there's a minimum rate guaranteed and when you're buying it right now, you will see the minimum rate. And then there is an inflation adjusted rate as well. So this year is 9.62. Next year, it may not be 9.62, but we don't see the inflation next year going down drastically down. So it may come down due to inflation, but the principle is safe. So yes, it is not guaranteed 9.62. It may go down if the inflation goes down.
So let's ask some general questions of interest. What should be our current asset allocation right now?
Yeah, so a lot of people asking the question, what should be our allocation? So it depends, so there's no creative, Dr. Kolli, out there. There's nothing, out there, like a lot of financial advisors we see, they come in, they say, I have this fund didn't go down or whatever. So yes, maybe once in a blue moon you will be right, but it doesn't mean consistently you're going to be right. So there's nothing called magic box out there. The way the system works, there are 4 portfolios in the market. If you're conservative, 50% should be in equity, 50% should be into fixed income, which we call it bonds. It's not long term, it's talking fixed income. If you're moderate, 60% ballpark should be in equity, 40% should be into fixed. If you're growth, 80-20, 80% should be aggressive, 20% should be into fixed. If you're super aggressive, 100% to equity. These are the 4 models in the market, universal.
Right.
In this market, the market is down almost close to S&P 20%. As long as you have 5 years horizon, again, everyone's situation is different. We don't know the full situation. We're not getting general comment. As long as you're 5 years, just a hypothetical situation, this is not the time to be super conservative because the market in 5 years, the chances of going is higher. So what, the way we are positioning our client, that is still have 20% in cash type of investment, not in long-term bonds. Short-term, 80% we are in right now because we believe the market has room to go further down, so we can still have a shot.
Yeah, it reminds me of the saying that a clock that has stopped gives you correct time twice a day, right?
Yeah.
So there's nothing like a right and wrong sometimes.
Correct.
Yeah. Okay. Interesting discussion so far. Best way to manage RMD. You might have touched on it a little bit. Can you go ahead again and repeat that?
Yeah, so one thing about required minimum distribution. So one good thing is that the market is down. So required minimum distribution after the age of 72, Secure Act. But if you're before Secure over the age of 70 and a half, you have to trigger. So that's usually about close to 4%. One good way of doing RMD, if you are charity minded, most people who are retired, they give money to charity. So one thing we don't recommend, don't take money out from retirement account is an RMD in your hand and give cash. IRS allow you to give 100,000 directly from the retirement account to wherever you want to. It's called QCD, qualified charitable distribution. The benefit is you save the Medicare tax, the 4%, the Medicare tax, FICA tax, you save some of them. So in this way, the money goes directly, doesn't come into your adjusted gross income. So again, for RMD purpose, try to do QCD rather than just taking money out. Then it becomes part of actual income and then giving cash.
Yeah, I have a pitch here. Do your QCD to AAPI, please. Thank you.
Right.
Okay, next, let's go to, in general, do you recommend physicians who are in retail investors should buy individual stocks or index funds?
Yeah, so my philosophy is very simple that I have yet to meet even a financial advisor myself. I'm doing it. I'm a fiduciary advisor doing it for almost 17 years. I yet to meet a financial advisor who beat the market, including myself. In the long run, we have seen the index funds always beat the market. All right, and most of the times, physicians I see buy stocks because their next door neighbors are buying it. Like Warren Buffett always says that if you're buying a stock, write down in a piece of paper what you're buying it. If you cannot write it down, don't do it. But we don't do it. We're a physician. We don't have time for it. We're just like, it's a WhatsApp group, whatever. We're seeing it and just we're getting into and buying it. So by all means, I'm saying this is a recipe for disaster, in my opinion. So the best thing to do is just buy ETF. You can diversify within ETF or index funds. Index funds in the long run, you save financial advisor cost, our cost, and you will be ahead of the game, in my opinion. Index fund passive income is the way to go.
Okay, so it's a simple information question. Where do I buy I-bonds? What website?
Yeah,
Probably
if
don't
you
have.
yeah, I don't if you just go to the Google it, Treasury Direct I bonds is directly with Treasury. There's no brokers out there, no financial advisors, so you can just buy directly.
Correct. Okay. Now the interesting question. I think we all have been trapped into this discussion. Is whole life a good investment?
Yeah, so it depends. But one thing the gimmick we see a lot of times is from the insurance agent that you buy a whole life insurance product, you pay the premium, and then after 10 years, you take the money out as a loan, and it's a tax-free growth, and you pay no taxes in it. Okay, really? So it never works though. Really in 10 years, I've never seen any growth whatsoever. So the whole life as an investment is a terrible product for sure. So unless your net worth is substantial and you're using whole life for estate tax purpose, my suggestion is to buy either term life or universal life. Save this premium you're paying and buy some mutual funds, index funds. So that grows 8% in the long run. You're ahead of the game. And this term life, you should cancel it, or the term life. Most time life, Dr. Kohli had the rider to convert it into whole life anytime. Your health is lock. So if you have a lot of net worth in 50 years, you can convert it anytime. That's fine.
Yeah. Dr. Mishra, a good Samaritan, he gave the website here, treasurydirect.gov/savings-bonds/I-bonds. So that is the place where you can buy your. And Dr. Arun has a very interesting question. It's all about psychology, right? Financial market and investing. Of all the citizens, do you think psychiatrists or psychologists do better in the market? I doubt it. Go ahead.
Right. So yeah, I mean as Warren Buffett says, be greedy when everyone is panicky, and be panicky when everyone is greedy. So the same situation comes into play. This is not really a time that to sell everything. It's time to do some tax planning. Those are better approach, and wait it out. That's the best way to go.
Right. I mean, like he said, when everybody's looking for exit doors, you get in, and and everybody's coming in, you get out.
Correct.
Right. Let's see. How long do you think it will take the market to recover? Yeah.
Yeah, so I wish I had the exact number. I could say like, this date, this time it will go higher, but we're seeing it that it takes about 3 years to things to stabilize it. But remember, right now, in any good news market is having a sell-off. So unemployment data is good, market will go more down. So it will be opposite of the economy. So when it happens that the bad data start to come, like Jimmy Jaman was saying, okay, real estate is bad, unemployment looks terrible, people are laying off and everything, recession is coming. That's the time the stock market, because stock market is forward looking. So it's very hard to predict, but the range we can talk about is going to be maximum about 3. We see it because what happened, the inflation is a global issue. It's not only US issue. So we believe as long as you have a 3 years time horizon, It's a go. 1 year is already passed. This year is done. Next year, we see in the middle, we see some improvements. We see recessions coming in, and the market from that point, it will predict what happens the coming quarter, and we should start to see in 2023 the market should start to like bottomed out and start to go higher.
Okay, so another Dr. Polepalli asked the question: should we buy whole life insurance for our children? So it's cheap, and also explain about buying life insurance for estate tax purpose. I'm in my 50s. Should I buy a 30-year term?
Yeah, so it's a good question that should you buy whole life for children? Yeah, so the philosophy
I don't know if it's whole life you meant, or let's see. Should I buy life? Oh yeah, whole life. You're right.
Yeah, whole life for children. Yes. So this is also popular. So the logic behind it is that you actually buy whole life for the child, and the health they don't really test too much. The underwriting is very easy, but that child, let's say, is 5 years old. By the time the child is going to be 30 years old, 35 years old, the money will grow. As long-term, the whole life works about 4% per year, and the death benefit proportionately go higher. So ideal candidate, this person who is asking, who's interested, either you have a lot of money or you get fooled by the insurance agent, either one. So if you have a lot of money, this is fine because you want to dispose off, you want to let's give this money to your children. I understand, all good. But one thing you don't want to do is buy whole life for the children thinking you will be able to use it for education. It doesn't work. In 10 years, there's no growth for the child. So again, for whole life for the children for education purpose does not make sense, but for them, if you have a lot of money, leave for them is fine. It's okay. Number
Right.
two, for you asked the question for estate tax purpose. Yeah, estate tax purpose, the best life insurance is not term life, second to die life policy called universal. Remember, if you die, there's no estate taxes due. Both husband wife dies, only then there's estate taxes due, right? So second to die universal policy is very cheap, is permanent. Go for that. That's the best way to handle it.
Okay, Dr. Vijaypura, my good friend, he's a psychiatrist. He says I do well as long as I follow my own discipline and not buy any junk stocks and keep it 10 to 20% short-term cash. I'm a psychiatrist, but I have been very foolish in my investment myself. Anyway, finally, why is estate planning important? I think that's a perennial question and important
Yeah,
question.
I think one thing to understand for physicians, this is a good time to do the estate planning done for physicians, because the COVID time, according to, if you see a Medscape and American Medical Association, almost 500,000 physicians get affected due to COVID. And we understand the importance of will and trust are very important. So a lot of physicians we speak to, they say that they only have a will or no will whatsoever. Whatever happens, we will see. So one thing to understand, if you don't have a will, just to give you an idea, something as simple as the custody of the children will be decided by the US government. So will is important. But even if you have a will, it doesn't happen that tomorrow if you die, your children get the money the next day. It takes some time called authentication by the judge. It's called probate process. Depending the state you live in, some state the probate is as long as 6 months. You can avoid it all of it by creating a revocable trust as well. And the beauty of revocable trust is once you die, the children inherit the money. It becomes irrevocable, and from divorce, all the assets are protected for them. So again, estate planning is a must. As soon as your net worth becomes more than 2 million, we always recommend get the will and trust done for physicians.
Okay. Okay, some interesting questions here. I think we always ask, but I never find the right answer. What is the difference between universal life and whole life? I think you probably can give a simple answer for that.
Yeah, so whole life, what happened, the money grows, whole life. So, and the death benefit is lower. Universal life, what happened, the money does not grow, it's pretty much stagnant. And the death benefit is higher. So you buy it, universal is permanent policy, you pay for 5 years, it's paid off, 10 years, you paid off, you're buying it mainly for death benefit.
Okay, very good. What kind of insurance for a 75-year-old for estate taxes for a single person?
For a single person, for estate taxes, yes, for a single person, you can still buy the universal life. It doesn't have to be second to die. And depending on how big is your state, if you are a single person, 70 years old, universal life is a better route. Whole life is going to be very expensive. The cash, you have to pay a lot. So the best option is, but we have to also, I'm talking about generic. You have to sit down with your financial advisor. How's your health? How's the longevity? If the longevity, if you have a health issue, then maybe term life is the way to go. But as long as you're physically active, usually we recommend universal life for state tax purpose.
Okay. So a lot of people ask, is it recorded? Yes, it is recorded. It will be on our website, and you can watch it or listen to it at your free time. And let me see. Okay, what is the best time to sell your losers? At the end of the year or any time?
Yeah, so the losers, we usually we do the tax loss harvesting in November, December, because that's the time we have some more clarity. But as the market is dropping, we are not waiting until the end of the year. We are doing the tax loss harvesting ahead of time for our clients. So what we are doing, that the stocks we are think doesn't have potential to go high, we sell it. We're buying something similar and carrying forward the loss. So the beauty is, Dr. Kohli, once you sell it, you can actually buy something similar, and if the stock goes up, you can book profit, and you have this tax loss harvesting going forward as well. So in this market is already down 20%, so we are not waiting, but you can wait out until November, December if you want more clarity.
Okay. Can you explain some basic asset protection tips? I know we're kind of going past our time, but I think discussion is going well. A lot of people are still here, so we can as well.
Yeah. So basic state asset protection. So one of the mistakes people see, that, like, for example, a lot of people asking questions about irrevocable trust to gift it to for asset protection, but it doesn't have to be that complicated for asset protection. For example, Pennsylvania, the state you live in, everyone says, okay, primary house not protected. Yes, and they're talking about like putting into LLC or irrevocable trust. It's not needed. For example, Pennsylvania have this amazing state statute called joint tenancy in entirety. As long as you own it under joint tenancy in entirety, it gives you asset protection. So again, some low-hanging fruits, it can be done. Defined benefit, 401k, joint tenancy in entirety. These are very basic state planning. As long as one of the spouse alive, you can do asset protection as well.
So some hands are raised. Let me see if I can get them to ask. I'll start from the top and then also start from the bottom alternatively. Okay, Dr. Dev, you want to talk and go ahead and ask your question if you're there, Dr. Dev. If not, I'll go to Dr. Saroj Shah. You're allowed to talk. You want to ask a question?
Hello, this is Dev.
Okay, go ahead, Dr. Dev.
Yeah, my question was, I think he was talking about NLE. And NLE, I got a lot of loss down there. Would you recommend to sell it?
Yeah, so obviously it's a generic question. I mean,
Yeah.
I'm just talking about, I mean, I have to look at the big overall situation, but it's a good time to do tax loss harvesting. But if you have a lot of NLY, if you can buy something similar, you can actually, do the tax loss harvesting. But if you have a lot of them, I would trim it for diversification. So we do have to look at the overall situation, but we are not big fan of REIT right now.
Okay. I'll let Dr. Hema Shukla talk. I'll unmute her. Dr. Shukla, I think she left. Okay, well, she's here. Go ahead, Dr. Shukla. If not, Dr. Shah, Saroj Shah, you can go ahead and ask your question.
No, my connection was off for quite some time. I could not hear. I just wanted you to explain Roth, backdoor Roth, and again, please.
Yeah. So basically, you are not, if your income is higher, usually about $224,000 ballpark joint, you're not allowed to contribute into a Roth IRA. But there's something called backdoor Roth IRA. What backdoor Roth IRA means, you are allowed to contribute into post-tax IRA account if you want to. There's no income restriction there, right? So you can open up a traditional IRA and contribute over the age of 50, 7,000 for you. If your husband, 7,000 for him, $14,000. Now, in conversion, there's no income restriction. So what you can do, you can open up a Roth IRA and convert the money traditional, you open it to the Roth IRA. Now, when you do a conversion, usually the tax is due, right? But if you do it instantaneously, like you just put the money into traditional and move it immediately to Roth IRA, now immediately, there's no gain, so there's no tax and there's no penalty whatsoever. So again, you converted it, now the money will grow tax-free. The withdrawal is also tax-free after the age of 59 and a half.
Okay, my good friend, Dr. Padma Narasimhan from California, she wants to ask a question. You can go ahead and ask Dr. Narasimhan. Okay, she's not ready yet. And let's see, Sanjay, you're allowed to talk. You can unmute yourself and ask your question, please. Okay, while we're waiting for him, why don't we go to Dr. Bogale, Vivek Bogale, you're allowed to unmute yourself and talk.
Hi, I had a question about the bond strategy. You had mentioned a shorter term bonds. What specifically would you advocate people get? I just wasn't sure about that component of it.
Yeah, so I'm just giving an example. Obviously, we cannot give a generic advice. For example, PIMCO short-term bond. I'm just giving an example. You can buy both the PIMCO short-term bonds mutual fund, or you can buy the ETF of that as well. But the reason why we go for mutual fund, because they have a track record. So they are still down. PIMCO short-term bonds or bonds like this around 5%, even they are short-term. So that's why overall bonds, I'm not too keen in right now, because Fed overall looks like we'll keep raising the rate at least for a few months. So there's no rush to buy it. So that's why, but the treasuries are better because PIMCO is down. PIMCO is giving 3, but they are down almost 4%. So net, you're not making money. Treasury, on the other hand, the principal is intact as long as the government doesn't file for bankruptcy, and they're giving you 3%. So that's a better approach right now.
Okay. Let me ask.
Hi, Dr.
Yeah, go ahead,
Ravi
Padma.
Kolli.
Yeah, go ahead.
Good afternoon. I thought it was unmuted, but it was not. So
No,
part of my questions were already answered, and I came in late, so I don't know whether that was covered or not. But anyway, I will listen to the record, I guess.
Okay.
But I also have a request. Can you please post it on WhatsApp or in the chat about how to buy the I-bond?
Okay, we'll put that link, definitely. Thank you. All right. And do you have a few more minutes you want to spend with our audience? Or
Sure.
Okay. Let me ask Dr. Vijaypura, my fellow psychiatrist, to unmute and ask some interesting questions. Go ahead,
So
Amit.
need some clarification on tax loss harvesting. So for example, if I take a tax loss and my loss is like 40,000 for the year, and then I can, of course, buy similar thing like you advise. Am I allowed to take a tax deduction of the whole 40,000, or I need to have a capital gain to offset that tax loss?
Yeah, so if you, let's say, for example, $40,000 you took a loss, you can carry forward. If you don't have any capital gain, the max you can write from the personal income is $3,000. Right. But it carries forward.
Yeah, it can be used for next 10 years.
Next 10 years.
Yeah. Right. And Dr. Sanjay, you were, okay, Dr. Arun, you were asking some interesting questions. Go ahead and ask your question, Dr. Arun, my good friend.
Yeah. So there is something called adjustable comp life. Northwest Mutual administers it. It's like whole life, but you get annual dividends, and after a while, your dividends are sufficient to pay your premiums. Would you recommend something like that for somebody that probably have a 10-year or 15 years to accumulate their premiums and returns and dividends?
Yeah, so as long as you have exhaust yourself in 401k, as long as you have exhaust yourself into real estate, mutual funds, everywhere, you have money, you don't know what to do about this. You want to have a tax deferred growth, and money needs to be asset protected. It's okay to buy whole life or adjustable life. The issue becomes, as a financial advisor, you buy whole life first, then you don't have money to do other stuff and your liability there. So again, it depending on your premium, depending the other, as a financial advisor, someone should take a look. But yes, if you have, but the only issue is 10 years is not going to be enough for you to accumulate it. Usually a life insurance to work, the time horizon is 20 years. First 10 years is all surrender charges and insurance costs. After 10 years, the insurance cost goes down, you start to see some result. So as long as you have a 20 years time horizon, it may work out fine.
Okay. And two last questions, and then we'll close. Dr.
Kolli,
Vakil,
can I ask you a question, please?
Yeah, go ahead, please.
Okay, so I don't know whether you covered it, but in a retirement portfolio, would you like to comment on variable and fixed annuities? Should it be there in your portfolio? And if it's already there, what to do about it? For retirement?
Right. So
Thank you.
annuity. So what happened? The background I'm coming from, we're fiduciaries. So we are anti-high fee. So you need to understand where we're coming from. So anything expensive, we are not okay with it. Annuity, the only issue I have it, any annuity you name it, at least I yet to see annuity cost less than 3% cost per year, right? And it's very hard to get out of it, the annuity. So annuity is very expensive. Unless you want guaranteed income, this is something you're adamant about, then yes, annuity, you can buy it. There is a case can be made. For example, if you want to buy annuity, let's say, I don't want to nothing to do with the stock market whatsoever. No, I cannot see market going down whatsoever. I want guaranteed income. Do you have a product like this? Beside real estate, you have annuity. So yes, you can go for it. A case can be made, but I believe we personally believe that you can in a retirement account, it's a tax deferred already. Why are you buying annuity?
And Dr. Vakil, if you're still here, you will be the last one to ask the question, and then we'll wrap it up with kind of summary.
I had a question. If you are over the age of 17, if you're working part-time, are you allowed to do that backdoor IRA, or can you contribute?
Yeah, so over the age of 70, the Secure Act passed, remember, so you should be fine. As long as you've earned income, you're okay.
Okay. I think we really covered a lot of topics, and thank you for staying over. And we have 127 people still here. Gives a testimony of your talk and your presentation and your kind of acumen and experience that you have. Thank you. And you want to say anything at the end? Then I'll wrap it up.
No, thank you very much. I really appreciate your time. And as I mentioned, that is very important to sit down with a fiduciary financial advisor who can go through your financial plan. Most of the stuff we're talking about, these are generic conversation. Don't act on it before you sit down. These are for educational purpose only, but sit down with your financial advisor before you make the move, because there's a lot of moving parts.
Yes. Again, I really want to thank all my family of AAPI members for being here and being supportive of all our endeavors to not only provide medical education and some level of financial education, right? And again, we're going to offer some more seminars and webinars related to financial planning, even disability insurance and all those things. So look forward to those, and please participate in those too. And it will be recorded and it will be available to you. Please visit our AAPI website, aapiusa.org. And I look forward to meeting you in person or in our webinars going forward. Thank you so much and have a great day. Have a good night.
Thank you, Kolli. Good night. Bye-bye.
Thank you. Thank you, Syed. Bye.
Thank you. Bye-bye.